Welcome to Upticks. I'm Jake Falcon, the founder of Falcon Wealth Advisors and your host of Upticks. Today is episode 135, Retirement Withdrawal Strategies. Okay, thank you for joining me back on the show. I hope all of you out there are staying safe and healthy during this horrible pandemic. For today's topic, I wanted to transition some recent client conversations I've had lately and explain a little bit how we coach our clients with their retirement withdrawal strategies. And believe it or not, this is probably very hard for most people to conceptualize it. And the reason is, I think, from having hundreds, if not thousands of conversations about this throughout my career, is that as Americans or as savers or as people working hard for our money, we get very accustomed, in our teens and 20s or 30s into just putting money away and saving it, right? And many of us, or many of our clients, have done that for 30 or 40 years. Actually, the majority of their lives, if you add up all their years, most of their lives, they have been putting money away to save it so that they don't have to work one day, right? So that the whole idea is that they're saving this money so that it generates an income stream so that they can live off that income stream. The problem is, and this is maybe a much bigger problem, is the problem in America is there's not much education around how to convert a nest egg, a big pile of money, into an income stream. And if you can think, so if our clients are in their 50s and 60s and 70s, their parents, okay, so the other generation, they really didn't have 401k. Some of them did, obviously, some of them saved and had stocks, but the far majority of them grew up in a different environment where they had pensions. Right. And sadly, typically a shorter life expectancy, not always, but most of that generation. So I'm talking about people that grew up or were born, in the 20s or 30s. Obviously during the Depression, that was still fresh on their mind. So they did save typically in a savings account. But when they worked, their employer took that burden of retirement on their shoulders and maybe didn't pay them as much of a wage, but provided them an income stream in retirement. Well, flash forward to people born in the 40s, 50s, and 60s, and now pensions are certainly a thing of the past. I mean, there's not very many companies certainly offering new employees pensions. And so now this burden of a withdrawal strategy or a retirement income comes on the individual. And so not only did their parents, it'd be like, people born in the 20s and 30s, they didn't teach that younger generation because they didn't have that obstacle to overcome. Now, the schools aren't teaching it either. So where does that fall? Well, that's job security for me at Falcon Wealth Advisors. And so that's what we do, a tremendous amount of coaching and work with our clients, explaining exactly when you make that transition into retirement, how are you going to replace your income? And I want to go over some retirement withdrawal strategies that we implement and maybe some that we don't, and kind of explain why we don't do the other ways. Okay, so the number one box that we like to check first is we don't like to have anything in the stock market that our clients are going to need to spend within the next 5 years at a minimum, ideally 10 years. Okay. So if you have $1 million and let's say you're 55 years old or 60 years old or whatever that is, but you're not getting Social Security, let's say you're too young for Social Security, and you need, just to make it the math simple, you need $50,000 a year from your account. And that probably isn't going to cut it for most people, but just for simplicity's sake. So if you have $1 million, we're going to recommend you put around $500,000 in bonds and cash and other fixed income like investments. Right. So that would be 10 years, right? So forgive me, that'd be 10 years of money, 50,000 a year, 10 years. So that would be ideal. The minimum we'd want to have in this scenario would be $250,000. So if you're going to spend $50,000 a year, 5 years, $250,000, 10 years would be ideal, $500,000. Okay, so that's where we typically start with the plan as we want to shape that. So let's say you need $100,000 a year and you've got $1 million. Well, then at a minimum, the same scenario would work out. We would need $500,000 at a minimum in bonds and cash. Okay, so first and foremost, the thing to think about as far as the way we manage money for our clients as they get into retirement is we wanted a minimum 5 years worth of money, not in stocks, ideally 10 years. Okay, 10 years. All right, and so then we build the portfolio around that. It's going to spit out a target rate of return, and then we plug all that into a financial plan, and we make sure that if we have enough money not in the market, is that going to allow for the other piece of the portfolio to grow so that our clients can appreciate or experience a pay raise as their retirement years persist? Okay, so first, we want that short-term bucket filled so that we don't have to worry about market risk in the short term when they need money. And then on the long-term side, we want to make sure that we've got enough money in stocks so that their portfolio can continue to grow. Right, so this starts the framework, and this is what we do for our clients in helping them determine, do they have enough to retire, and can we sustain that retirement withdrawal strategy over hopefully a 30, 40-year retirement time horizon. Okay, so that's the big piece of it. That's a big bulk that I threw out there. So just remember, 5 to 10 years in bonds and cash is what we target. The rest in stocks, because we've also got to grow the portfolio. And we make sure that that target rate of return is going to sustain their lifestyle. Now, we also take other income streams into consideration. So eventually you will get Social Security, or maybe your income will drop if your mortgage is paid off or other debts, or maybe you do have a pension. You're one of the lucky ones to have a pension. So we do factor all of those other income streams into the equation when we're looking at that. So that's why, again, it pays to hire a competent chartered retirement planning counselor, such as myself or Corey. The two of us are both chartered retirement planning counselors, which simply means we've been trained to have these conversations with our clients and set up these types of financial plans. Okay, so that's just framing the financial plan. Now, on investment side of it, an ideal situation, and this doesn't happen for every client, but ideally, we also like to see enough dividends and bond interest to sustain that income stream. So that's even a better scenario than the 5 to 10 year bucket. So if we can invest the money for a client and we look at their projected income, which all of our clients have that. So if you are a client and you don't know where to find that, certainly let me know, and I can direct you to a teammate on my team that can show you how to find that. But we can add up that projected income and in our scenario that we used earlier. If you need 50,000 or 100,000, whatever it is, if your projected income equals that income that you need, then that tells me that you'll never have to tap into principal and that you can just live off your income from your investments, which is a beautiful thing. Now, there is no guarantee here. I want to be very clear. That projected income can change. So that's why it pays to meet with us, at least once or twice a year to review that income stream and make sure that's still set up. And the beauty of owning stocks and bonds, the way we see it, is that we can always adjust that income stream too. We can buy a higher dividend paying stock or swap out a bond for a different bond. So we can actually control what that projected income is somewhat, right? You still have to have the money to support it, but we can control that number a little bit. All right, so that's the second piece. So first off, with the plan, we want to make sure we've got 5 to 10 years in there so that short-term volatility doesn't put you at risk. And then we also want to have enough in stocks that we can grow and hit that target rate of return. Hopefully, again, there's no guarantee that way you don't run out of money, right? You don't want to retire typically and put it all in cash unless you've got enough cash to sustain that. But typically that cash isn't going to grow, so you would deplete as you withdraw from your retirement nest egg. And the second point on the investments, again, ideally, we love to see enough dividend and bond interest to carry through on that income. If it doesn't, I don't want you to be concerned. Then we just use a combination of that income and growth to fund that retirement withdrawal strategy. Okay, so again, this is why our clients come to us. We really focus on enhancing our clients' financial literacy and explaining exactly what their financial plan means to them. So this is very high level today. With each of our clients that has a financial plan, we want to dig down deep and show them exactly what I'm talking about. Before I go into some of the strategies that we do not implement, and I'll tell you why, I want to give a quick shout out. If you could please subscribe to my podcast here or Upticks. on the Falcon Wealth Advisors YouTube page or your favorite podcast platform. I've been very humbled. Our subscriber rate continues to grow and increase. So again, feel free to mash that subscribe button. And if you like our content, hit a thumbs up button. I think that'll get more of our content in front of more people, which is, again, our aim is to enhance the financial literacy of our clients. Okay, so what about some strategies that I don't like? Number one, a huge one that I've disagreed with for many years are annuities. And annuities is an insurance product that, quote unquote, offers some sort of guaranteed, again, only guaranteed by the annuity company, of an income stream. So you can think of it as a pension, right? And smartly of the insurance company to create these products is they look to simplify it for people. Hey, give us your $1 million, slap in an annuity, and we'll kick out $2 or $3 grand a month or whatever it is. And it'll be, quote unquote, guaranteed by us. I don't like annuities. They're very restrictive, so it's hard to get your money back out of them. The fees are enormous, in my opinion. And all they're simply doing is they take your money and they go invest it in stocks and bonds. So I find them somewhat useless for at least our clientele. They probably do serve a need for maybe a different subset of people. But for us, we haven't seen a case where they make sense. So I'm anti-annuity. I don't like them. I just think they're very restrictive. Their fees are very high, and you don't need to do it that way. If you hire a fiduciary-minded advisor that's been trained to work with retirees and their withdrawal strategies, and they help you stay disciplined, which is obviously very important. That's one of the boxes, at least annuity, it checks. It forces that discipline for some people. But other than that, I don't like it at all, and we don't use them. So that's a big one. Another one, some of these, other insurance products we don't like using. Again, we would like to keep it very pure. We want to use stocks and bonds and trade options for our clients. We want to cut out the middleman. We want to keep costs low and do things like that. Some advisors out there I've seen will also have, maybe 3 or 4 years worth of money in cash. I think that's a little excessive. I think if you properly diversify your bonds using treasury notes, preferred stock, corporate bonds, municipal bonds, tax-free bonds, there's some things that you can do to get a little bit more yield. So I don't like using that approach. Again, I don't want to put 3 or 4 or 5 years in something that's not going to earn our client any return. So I don't like using that strategy. And then some advisors, the extreme opposite, use all stocks, which I don't agree with that either. Because again, you've got a lot of volatility. If you have all your money in stocks and no bond component, and if we do have a market crash or correction and you need to sell something, that's a tough conversation to have or a decision to make. Even if you're diversified, when things collapse, when they do it quickly and abruptly, typically everything comes down. So you don't want to have to worry about selling something, when the Dow's down 2,000 points, you don't have to call up your advisor and say, can I go buy milk? I need money. That bond and cash component to me is much more useful than having it all in stocks. So those are a few of the strategies that we don't use. Again, so if you have any questions, if you're a current client, certainly, and you want to set up a time to meet with your advisor, don't hesitate to reach out to us. If you're watching or listening to this and you are scared about retirement or want some answers on how your withdrawal strategy is going to look, please don't hesitate to reach out to me. You can email me at jake@falconwealthadvisors.com. I'm also out there on 4 social media platforms. So I'm on Instagram, Facebook, LinkedIn, and Twitter. If you want to connect with me, certainly that's another way to get a hold of me. Our team is also out there on those same social media platforms as well. Falcon Wealth Advisors is on Instagram, Twitter, LinkedIn, and Facebook. So go ahead and give us a follow or connect, and you can see more of our great organic content that we're kicking out here for our clients. Okay, so that's all the time that I do have for you today. What's new with me? Business as usual at the Falcon residence. The Augusta room is taking shape. We've got some art on the walls, waiting on our couches. So I'm excited to get those here pretty soon. I'll probably send some more pics on that. Started to play golf, which has been a lot of fun. I'm excited for spring to be in Kansas City here soon. Like I mentioned, I hope all of you out there are staying safe and healthy, and I hope you have a great week.